Hi, everyone. Welcome to Halftime 2013, presented by Josh Nelson and Keystone Financial Services. At Keystone, we guide our clients to achieve financial security by building trusted relationships and providing expert financial advice, exceptional service, and proactive communication. Our objective today is to evaluate where we've been, where we are, and where we may be going. As always seems to be the case, this has been an interesting year, so let's talk about where we are through June 30th. So far this year, the S&P 500 has been the clear winner. Those would be your U.S.-based companies, up 12.5%. International, in general, down 1.1%, largely because of emerging markets. 10-year Treasury yield up 2.49%. Is that good? Well, it depends on who you are. If you own bonds, not such a good thing, as that's resulted in a big drop in bond prices in general. And finally, gold down a whopping 28.2% year to date. In January of this year, Bill Miller said the great bond bear market has begun. Also in January of this year, Bill Gross, manager of PIMCO Total Return Fund, which is the largest mutual fund in the world, said, "I'm afraid there's going to be ashes in our stockings this year," and that applies to all asset classes. Bonds are priced not just for perfection, but with close to 0% yields. The juice has been squeezed out of the orange. In other words, rates can't go below zero. And finally, also in January of this year, Carl Case from Wellesley College said, "There are a lot of reasons to be optimistic, but cautiously so." One of the main financial headlines of the first half of 2013 is the large gains that we've seen in the stock market. New all-time highs were set in both the S&P 500 and the Dow Jones Industrial Average. But is it sustainable? A common question is, now that we've seen these all-time highs, it would be crazy to get into the market now, right? Actually, history would show that following a new all-time high, the market continues to rally another 28% on average. Also, as shown in the chart, new all-time highs often come in bunches, with large gaps in between. In 2012, politics dominated the investment landscape. Investors were distracted by an election year combined with a near catastrophe that was the fiscal cliff. Now that those fears have dissipated and economic growth has remained positive despite this large drag on growth from government spending cuts, the markets have rallied. If government spending and tax increases are chopping nearly 2% from economic growth, and we're still growing at nearly 2%, simple math would suggest that the rest of the economy is actually growing at a very healthy rate of 4%. Despite higher taxes this year for nearly every working American and mediocre new jobs numbers, the U.S. consumer has been incredibly resilient. U.S. retail sales have climbed to new all-time highs, and consumer confidence is the highest it's been in over 5 years. The U.S. consumer is clearly getting better if they can continue to spend more, even in the mediocre employment market. Even those fortunate to have jobs haven't seen much of an increase in their paychecks these last 4 years. Wage growth has remained below 2% since 2009, except for a brief period in 2011 when growth slightly ran above 2% for a couple of months. Despite fewer jobs and low wage growth, Americans have been diligently paying down debt. In fact, total U.S. consumer debt is $1.37 trillion below its 2008 peak. The economy has been experiencing lackluster growth because businesses and consumers have been paying down debt and strengthening their balance sheets. Now that balance sheets are beginning to look more healthy, wage growth is most likely going to increase back to historical averages, which would result in stronger economic growth. Speaking of jobs, who actually works here anymore? The answer is not very many people. In fact, only 33% of the population is currently participating in the private sector labor force. Another approximately 10% work for the government, but even when adding that, more than half of our population isn't working. A whopping 90 million people could be working, but have simply given up even searching for a job. This is vital to understand when hearing that the unemployment rate has declined. There really aren't that many new jobs being created, and the official unemployment record is only declining because people are dropping out of the workforce due to many people who have given up looking for a job altogether. The table shows more specific statistics that a net 15 million people have dropped out of the workforce since 2000. That all being said, things are starting to turn the corner. This last year, people rejoined the workforce, so this trend is about to reverse. One of the largest negative contributors to the last recession was the housing market, and now one of the largest contributors to the recovery has also been the housing market. Home prices are rising at a double-digit pace, and new homes are being built at a brisk pace. The largest asset of many Americans is their home. As this asset increases in value, people feel better off and will become more positive. This results in more spending and an improving economy. Things got a lot more interesting after Bernanke surprised many by giving more indication that the Federal Reserve is getting closer to slowing or tapering their asset purchase program that many people believe has fueled this great stock market rally we've seen. The Fed raised their economic growth forecast for 2014 and believed that major risks to the economy have considerably declined. Now, if the economy is getting better, that's good for corporate sales and earnings, meaning stocks will continue to perform well. But even if the Fed is wrong and the economy isn't getting any better, they can just continue to use quantitative easing to help support economic growth and asset prices. Also, with less Fed intervention, interest rates will rise and investors will come back into the stock market in search of returns as bond prices decline. One of the fears that's still out there about the Fed's quantitative easing program is that it will create rapid inflation. Well, we haven't seen much of that yet. In fact, two gauges of inflation, the PCE and the CPI, have both consistently shown consumer prices rising less than 2%. That being said, inflation might be waiting in the weeds. The seeds have been planted, and now it's only a matter of time when that cash will flood into the economy, resulting in inflation. Following the shift in the Fed's stance on the economy, interest rates moved higher quickly. The yield on the 10-year U.S. Treasury leaped from 1.6% at the beginning of May all the way to 2.6% in June. Of course, bond prices move inversely to interest rates, and bond investors suffered steep losses. Also, much of the money that flowed into speculative assets like gold was yanked out as investors realized that the Fed wouldn't continue their bond purchasing program forever. Now, interest rates are increasing because the Fed's pulling back on their program as the economy improves. If the economy is improving, that means stocks should do well. Now let's talk about where we are today. The current state of the financial markets can be best highlighted by the following: the wealth effect, the fact that the U.S. is still a tale of two nations, consumers gaining confidence despite structural economic issues, corporations having lowered earnings expectations, geopolitical tensions, and stocks trading just below all-time highs. As important assets, such as stocks and homes, continue to increase in value, U.S. households are beginning to feel more wealthy as a result. U.S. household net worth has reached a new record high and was up nearly 10% from this time last year. U.S. households will continue to feel more confident in the future as their balance sheets become more healthy, and this will result in better economic growth and stock prices. Despite the spending increases, corporate earnings are still only increasing at a moderate pace. This chart shows earnings per share of the S&P 500 only increasing by 4% in the first quarter of 2013. This is after only 2% growth in all of 2012. The consensus expectations are for earnings to only increase by 3% for 2013 before accelerating significantly in 2014 and 2015. That's good news for stocks if you're a long-term investor. Always a wild card in the financial markets is geopolitical tension. It was announced recently that the White House intends to arm Syrian rebels who are in the midst of a civil war. Apparently, the president of Syria, Bashar al-Assad, has used chemical weapons, which was a red line that President Obama established as a deal breaker for getting involved. Russia isn't happy with us for supporting Syrian rebels who have questionable affiliations and motives. To top it off, an ex-CIA employee went rogue and is believed to have been hiding in Russia, and of course Russia hasn't cooperated with extradition, and tensions have increased as a result. That being said, things like this happen every year, and there is opportunity to invest here as market participants exercise unwarranted action by not participating in this attractive market. Now let's talk about where we may be going in the future. We've covered where we've been and where we are. Let's talk about the most important things to keep an eye on for the remainder of this year. One thing everyone can agree on for sure about the Federal Reserve's quantitative easing program is that it did give borrowers some incredibly attractive interest rates on their loans. Much of the housing recovery could perhaps be tied to the fact that people could afford more home for their dollars because interest payments were so low. However, if this is reversing, it could potentially now become a headwind to consumers making large purchases. For instance, We witnessed the largest monthly increase of mortgage rates in 30 years in June, as the average rate on a 30-year fixed mortgage leaped to nearly 4.5% from under 3.5%. While a 1% increase still puts you at near record low borrowing rates under 5%, if this trend continues, it could be costly for future home buyers. For example, in the table above, someone who wishes to buy a home for $300,000 will pay $500 more per month and over $182,000 more in interest payments over the life of the loan if mortgage rates increase from 4% all the way to 7%. Now, we believe interest rates are still very low and are only one component of purchasing decisions. Also, there are many savers who would benefit greatly from more attractive interest rates as they climb higher. Also, bonds will continue to lose value as interest rates move higher and investors will flock back into stocks. More on that later. For years, China has notched stellar double-digit economic growth. However, with new leadership in place and fears that China has overextended themselves by fueling growth by borrowing to build unnecessary projects, growth is now slowing. China's economy grew 7.7% in Q1 2013 and is expected to now notch growth of less than 8% in 2013. As a result, China's stock market has lost value. China is focusing on creating more sustainable economic growth through consumer spending, but that could be a tough transition. That being said, China is doing the right thing and they're still growing over 7%. It's not as if China is going into recession anytime soon. The second largest economy in the world is now still advancing at more than double the pace of other large economies. Imagine how ecstatic Americans would be if our economy was growing at 7%. Europe is still a mess, with most of the Eurozone having negative economic growth. Unemployment, especially among youths, is at high levels. For example, in Spain, 56% of youth are unemployed, and 26.8% of the entire country is unemployed. The entire Eurozone currently has 12.2% unemployment and 24.4% for youths. The European Central Bank stepped in to support the economy by any means necessary, and this provided a backstop at least for financial markets. Bond yields on government debt have remained at reasonable levels, and a crisis appears to be contained at this point. Europe is bottoming out, and the central bank offering the backstop last year will prevent a widespread catastrophe from occurring. Growth will most likely resume at some point over the next several years, and the marginal improvement will provide a tailwind for stocks. The Great Rotation started to become a popular term in the investment community late last year. The theory goes like this. Nearly $500 billion has departed from stocks since 2007, while more than $1 trillion went into bonds and other income-producing assets. The theory looked like it was wrong up until June of this year, when investors started to turn negative on bonds. If the Federal Reserve is correct and they begin to end their asset purchasing program, there is a chance this theory will become reality as investors flood out of bonds and pile back into stocks. We must always be cognizant of the potential for military conflict and the effect it has on the economy. There are many different spots on the map that are currently either in conflict already or appear close to having a war break out. Should any superpowers become involved, the effects on certain areas of the financial markets could be severe. Now, we're not experts in this area enough to give a probability of this occurring. We're simply pointing it out, what appears to be an elevated concern at this point in time. And with that, we'll end by saying thank you for your attendance, thank you for your continued support, thank you for your business. Please let us know if there's anything that we can do to help you, a family member, a friend, or a coworker.